So usually when you think about a massive legacy oil and gas company, you picture, a dinosaur.
Right, yeah. Like something from another era entirely.
Exactly. Something slow, lumbering, and just deeply tied to the boom and bust cycles of the past century.
Oh, for sure. The conventional wisdom definitely paints them as these relics of the industrial age.
Right. You expect a lot of rust, a lot of rigid, old school thinking, and almost a fatalistic acceptance of the commodity roller coaster.
Yeah, the broader market assumption is often that these exploration and production giants, they just ride the wave of global oil prices, right?
Hoping to survive.
Pretty much. Just hoping to survive the inevitable macroeconomic crashes and then, cash in during the geopolitical spikes.
Right. You picture roughnecks turning wrenches and executives just sitting in a boardroom praying for crude to stay above $50 a barrel.
Yeah, that's the classic image.
But looking under the hood of a modern exploration and production giant today, it completely shatters that preconceived image.
It really does. It's totally different now.
What we're actually looking at today is an enterprise operating with the precision, the scale, and, honestly, the data-driven obsession of a Silicon Valley tech firm.
Yeah, that's a great way to put it.
The only difference is they're dealing in physical molecules deep underground instead of, digital bytes in a server farm.
Exactly. The transition from a purely physical extraction industry to this highly digitized, manufacturing style process that is the defining shift of the last decade in the energy sector.
And that is exactly the realization we are going to explore today. So welcome to this Talk Tickers Deep Dive.
Glad to be here.
Our mission today is to break down ConocoPhillips Q2 2026 earnings call. We're taking all that dense Wall Street jargon, the analyst acronyms, the complex financial engineering, and we're translating it into actionable, plain language for you, the retail investor.
Right, because it can get really dense.
Super dense. The goal is to deliver a concise, data-forward analysis so you can decide if this stock, which trades under the ticker CO, actually belongs in your portfolio.
And we are setting the stage with the quarter that is, by all definitions, just massive.
Oh, huge.
Yeah, this is not just another routine operational update. What we're analyzing here is a sheer scale of operation that is almost hard to comprehend.
It really is.
We're talking about record-breaking production volumes, a monumental transition in corporate leadership, a literal war chest of cash, and a highly structured multi-year strategy designed to completely detach the company from the historical volatility of the broader energy sector.
Right. You cannot argue with the math here, and the math they presented is staggering. Let's just start by looking at their core earnings and production.
Yeah, let's get into the headline numbers.
So ConocoPhillips reported an adjusted earnings per share, or EPS, of $3.24 for the second quarter.
Right, and that adjusted EPS figure, that's the first metric institutional investors look at.
Because it strips out the noise.
Exactly. It strips out one-time accounting anomalies. It gives you the actual run rate of the underlying business.
Gone.
So $3.24 per share generated in a single 90-day period that points to an incredibly robust cash-generating apparatus.
But, the number that truly jumps off the page for me, and the number that drives that EPS, is the physical production figure.
Oh, absolutely.
They pumped out 2,248,000 barrels of oil equivalent per day.
Which is just crazy.
Right. That's BOE per day, for short. And that number didn't just meet market expectations. It beat the high end of management's own internal guidance.
Yeah, and putting that production number into perspective is just critical for understanding the scale we're dealing with.
Right.
Over 2.2 million barrels of oil equivalent every single day. That is a river of energy flowing into the global market.
And the term equivalent is vital for you to understand here, right? Because an energy company like this isn't just pulling black liquid crude out of the ground.
No, not at all. It's a really complex mix of crude oil, natural gas, and natural gas liquids, or NGLs. And you can't just add a cubic foot of invisible natural gas to a physical barrel of liquid crude and get a mathematically meaningful number.
Obviously not.
No.
So how do they standardize it?
Well, the barrels of oil equivalent metric equalizes everything based on inherent energy content.
Oh, okay.
So for context, roughly 6,000 cubic feet of natural gas contains about the same amount of combustible energy as one standard barrel of crude oil.
Makes sense.
So by converting their immense gas and liquids output into this single unified metric, they give you a standardized view of their total energy extraction.
Got it. And beating the high end of their own guidance in a quarter that's marked by global macroeconomic volatility.
Yeah.
That's not just a slight over-delivery.
Oh, it's a huge deal.
When a company the size of ConocoPhillips beats its own internal engineering models, it points to operational execution that is incredibly tight.
Yeah, it means the reservoirs underground are yielding more products and their surface facilities are experiencing way less downtime than even their most optimistic conservative estimates predicted.
Wow.
It also speaks to the reliability of their forecasting, In capital-intensive industries, predictable modeling is highly rewarded by the market.
Totally.
When you beat the high end, you establish a real track record of operational credibility.
And pumping out that much product creates this massive financial fortress.
Yeah, the cash flow engine.
Exactly. For the quarter, they generated $7.2 billion in cash flow from operations, which, you'll frequently hear referred to on these calls as CFO.
Right.
Now, after you subtract the $3 billion they spent on capital expenditures, the CapEx, which is the money used to drill new wells, lay pipelines, maintain facilities, that leaves them with $4.2 billion in pure free cash flow in just 3 months.
Yeah, it's wild. And the distinction between cash flow from operations and free cash flow, that's basically the bedrock of energy investing analysis.
Right, because CFO is just the raw cash generated by the day-to-day business of selling the extracted oil and gas, right?
Yeah. Exactly. But a natural resource company cannot simply pocket all of that revenue. The fundamental reality of the energy business is that you are constantly fighting decline rates.
Because the wells dry up.
Right. The moment you drill a well and it starts producing, the pressure drops and the output begins to decline. You have to continuously reinvest in the business, drilling new wells, just to keep your overall production flat.
Let alone to actually grow it.
Exactly.
So that constant treadmill of reinvestment, that's the CapEx.
Right.
The fact that their CapEx was only $3 billion against a massive $7.2 billion in operational cash flow, that reveals a massive margin of safety.
Oh, completely.
They're not spending every dollar they make just to stay in place. That $4.2 billion in free cash flow is purely discretionary money.
Yeah, it's the capital that allows them to pay dividends, buy back stock, pay down debt, or, make strategic acquisitions without having to go to the bank and borrow a dime.
Which is huge.
It demonstrates exceptional capital efficiency, generating that wide of a spread between operational cash and required capital expenditures. That is the ultimate goal of any exploration and production company.
And it directly feeds into the health of their balance sheet, too.
Exactly.
Their balance sheet right now is essentially bulletproof. Their leverage is well below 1x.
Which is amazing.
Right. And they are sitting on an absolute mountain of liquidity. $8.1 billion in cash and short-term investments, plus another $1.2 billion in liquid long-term investments.
Yeah, they essentially have almost $10 billion in highly liquid capital just lying around ready to be deployed at a moment's notice.
And a leverage ratio below 1x, that's a radical departure from the historical norms of this industry, isn't it?
Oh, it's completely different. Leverage is basically a measure of how much debt a company carries relative to its earnings.
Right.
And in decades past, energy companies were notorious for these debt-fueled drilling binges.
Oh yeah, drill, big baby, drill.
Exactly. During a commodity boom, they would borrow heavily from Wall Street to lease vast tracts of land and drill as aggressively as possible, just chasing pure volume.
And we know exactly how that movie ends.
Oh, yeah.
When the inevitable commodity price crash occurred, their revenues plummeted, but their fixed interest payments on that massive debt load remained exactly the same.
Right.
They were just crushed under the weight of their own leverage.
But by maintaining leverage below 1x and holding nearly $10 billion in liquid assets, ConocoPhillips has structurally insulated itself from credit market shocks.
So they're safe.
Very safe. If global oil prices were to suffer a catastrophic collapse tomorrow, they have the cash buffer to absorb the blow without distress.
Right.
And furthermore, it gives them the strategic optionality to go on the offensive during a downturn.
Oh, right, like buying up competitors.
Exactly. Potentially acquiring distressed competitors who weren't as fiscally disciplined, buying prime assets for pennies on the dollar.
Okay, so that fortress balance sheet brings us to what they are actually doing with all that discretionary cash right now, which is prioritizing shareholder returns.
Big time.
This quarter alone, they returned $3 billion to shareholders.
Oh.
Yeah. That breaks down to $1 billion in ordinary dividends, putting cash directly into your brokerage account if you own the stock.
Nice.
But the other massive piece of this is $2 billion allocated to share repurchases. And this is where we need to pause and critically examine their capital allocation.
Okay. Why?
Because that $2 billion is double the amount of stock they bought back in the prior quarter.
Right. Doubling the pace of share repurchases is a significant acceleration.
Yeah.
By buying back their own stock on the open market and retiring those shares, they are reducing the total number of shares outstanding.
Right.
So the mathematical result is that every remaining share, including the ones you hold as an investor, now represents a slightly larger ownership percentage of the company.
And a larger claim on earnings.
Exactly, and consequently, a larger proportional claim on all future earnings and dividends.
Okay, wait, I have to jump in here and just push back on this aggressive buyback strategy for a second.
Sure, go ahead.
Because as an investor, whenever I see a cyclical commodity company doubling its share repurchases, my alarm bells start ringing.
I get that.
A classic critique of legacy oil companies is that their capital allocation is fiercely pro-cyclical.
Right, they buy high.
Exactly. They make a ton of cash. When oil is sitting at elevated prices, they decide to buy their own stock at those premium inflated prices. And then when the commodity cycle inevitably turns and oil crashes, they slash their buyback programs right when the stock is actually cheap and trading at a discount.
Right.
So, I mean, are they just swimming in so much cash right now that it's burning a hole in their pocket? Or is there a fundamental structural reason management believes the stock is genuinely cheap today?
Well, the concern over pro-cyclical spending is one of the most common friction points between energy executives and Wall Street analysts. In fact, multiple analysts on this very earnings call brought up that exact concern.
See? I'm not the only one.
No, you're definitely not. But management's defense against the accusation of buying at the top of the market rests on a profound structural transformation of your cash flow profile, not just a reliance on high current oil prices.
Okay, how so?
Management is explicitly projecting that they are on track to double their free cash flow by the year 2029.
Oh, wow. Double
it.
So they are essentially ignoring the spot price of oil today, looking at their internal engineering and financial projections that show a doubling of their disposable cash in just a few years, and betting that the broader market simply hasn't priced that reality into the stock yet.
Exactly right. The current share price is viewed by management as deeply discounted relative to the $7 billion free cash flow inflection point they're steering toward.
I see.
As Ryan Lance, the outgoing CEO, stated clearly on the call, if a company delivers that magnitude of free cash flow growth over a multi-year period, the share price fundamentally has to appreciate to reflect that new reality.
That makes sense.
Therefore, repurchasing shares heavily right now is not a reactionary spending spree just because they had a lucrative quarter. It is a calculated strategic investment in their own internal growth trajectory.
Right.
They're signaling to the market that until investors believe the 2029 projections and bid the stock up, the company will gladly buy its own equity at a perceived discount.
Okay, that is fascinating. So the core of this entire financial engine and the reason they can generate this kind of cash starts geographically in Texas.
Yes, it does.
We need to zero in on their dominance in the Permian Basin and the almost unbelievable level of technological efficiencies they are employing there.
Right. The Permian Basin is the undisputed crown jewel of American shale production.
Yeah.
For ConocoPhillips, it accounted for 920,000 of their total 2.2 million barrels of oil equivalent per day this quarter.
Wow, almost half.
Yeah. That specific basin represents a 10% year-over-year underlying growth rate, completely outperforming the growth rates of their major peer exploration and production companies operating in the exact same region.
So let's break down the mechanics of how they are achieving that outsized growth, because it's not just luck.
No, definitely not.
Management spent a significant portion of the call discussing, quote, DNC efficiencies.
Right.
In plain English, that stands for drilling and completions. It is the physical process of getting a hole deep into the ground and then stimulating the rock to get the hydrocarbons out.
Exactly.
And they are executing this with incredible speed and scale. They noted they are now drilling 15% longer horizontal wells, effectively doubling the deployment of their 3-mile-plus laterals.
Yeah, and to truly appreciate the engineering involved here, we kind of need to visualize the drilling process.
Okay, paint a picture.
Historically, an oil well was drilled vertically, just straight down into a reservoir like a straw into a cup. But shale rock is different. The oil is trapped in these thin, horizontal layers.
What a layer cake.
Exactly, like a layer cake. So modern operators drill down vertically, perhaps 1 to 2 miles deep. Then, using incredibly sophisticated telemetry and steerable drill bits, they turn the wellbore 90 degrees and drill horizontally directly through that specific layer of oil-bearing shale.
And that horizontal section is called the lateral.
You got it, that's the lateral.
And drilling those laterals out to 3 miles, and I mean, in some experimental cases, 4 miles long, is just a staggering logistical feat.
Oh, it's mind-blowing.
You're sitting on a drill pad on the surface in West Texas, guiding a drill bit miles underground, and keeping it confined within a specific geologic formation that might only be a few dozen feet thick.
It's incredible, and the economic advantage is massive.
Right.
By drilling longer horizontal laterals, they expose exponentially more of the oil-bearing rock using only a single vertical wellbore.
So they don't have to drill as many holes from the surface.
Exactly. It massively reduces the surface footprint, requiring fewer well pads, fewer access roads, fewer surface facilities, and it drastically lowers the capital cost required per barrel extracted.
But getting the wellbore drilled and lined with steel casing, that's only the first phase.
Right.
The rock itself is entirely impermeable. You then have to complete the well by fracturing the rock, fracking it, to create pathways for the trapped oil and gas to actually flow into the pipes.
Exactly.
And the executive in charge of Lower 48 operations highlighted their deployment of real-time fracture diagnostics.
Which is super cool.
Right. The evolution of fracking technology is fascinating. Historically, a petroleum engineer would sit in an office, design a fracturing program based on some core samples, apply the exact same pressure, volume of water, and volume of usually sand to every single section or stage of the well.
And just hope for the best.
Literally just hope the geology responded uniformly. But now they're deploying real-time diagnostics. They are reading acoustic and pressure signals from deep underground to understand exactly how the rock is shattering and responding in real time.
While it's happening.
Based on that live data, they are actively adjusting the volumes of their frac stages by up to 30%, altering up to 60% of the stages on a single well compared to the original static design.
Right, so they're no longer treating the rock as a uniform monolith.
No.
They're customizing the fracture stimulation to the precise minute-by-minute geological variations they encounter along that 3-mile lateral.
Which is just wild.
It is. This prevents wasted capital on rock that won't yield and focuses intense stimulation on the most productive zones.
But the mechanical fracturing is being paired with a chemical innovation that management highlighted, which I find even more interesting.
Yeah.
The injection of specialized surfactants.
Oh yeah, this is a big deal.
Let's look at the chemistry here because it's incredibly intuitive when you understand it. A surfactant is fundamentally the active chemical ingredient in household soap.
Right, like dish soap.
Exactly. If you're working on a car engine and your hands are covered in thick grease, running them under water alone won't wash the grease off. The surface tension of the water prevents it from interacting with the oil.
Yep.
You add soap, the surfactant lowers the surface tension, allowing the water and oil to mix, and the grease slides right off.
It's that simple.
So ConocoPhillips is essentially injecting highly engineered industrial surfactants into the shale rock miles underground to wash the stubborn oil out of the microscopic pores.
Right, because shale rock is categorized as a tight formation, meaning the pore spaces holding the hydrocarbons are incredibly small.
Like microscopic.
Yeah. Even after a successful mechanical fracture, a significant percentage of the oil stubbornly clings to the surface of the rock due to capillary pressure and surface tension.
It just won't let go.
Exactly. By utilizing these fit-for-purpose chemical surfactants in their fracturing fluid, they alter the surface tension dynamics between the crude oil, the injected water, and the shale rock itself.
But, I always look at the cost-benefit analysis of these chemical enhancements.
Yeah, truly.
You're introducing a specialized, likely expensive industrial chemical into a process that traditionally just relied on cheap water and sand.
Right.
Are the margins really improving, or are they just trading one expense for another?
Well, the unit economics of the surfactant deployment are highly favorable.
Oh, really?
Yeah, the early data they reported is remarkable. They're showing up to a 20% uplift in total oil productivity for a surfactant-treated well versus an untreated offset well.
Wow, 20% is massive.
It is. And while the chemicals certainly add an upfront cost to the completion phase, extracting 20% more total resource from a wellbore that you've already spent, $10 million to drill and case that drastically lowers the overall fully burdened cost per barrel.
That makes total sense. They are taking the inherent chaos of subsurface geology and turning it into a highly controlled, optimized manufacturing process.
Absolutely.
When you combine 15% longer laterals, real-time customized fracture diagnostics, and advanced chemical surfactants, they're pulling significantly more oil out of the exact same acreage for less capital expenditure per barrel.
Right.
That relentless focus on capital efficiency is what continuously widens their free cash flow margin.
Exactly. And amidst this technical discussion of record production, the Q2 call also served as a formal marker for the end of an era in corporate leadership.
Oh yeah, the CEO transition.
Right. CEO Ryan Lance announced his upcoming retirement effective September 1st. He has been at the helm as CEO for 14 years, capping off a career of over 40 years at ConocoPhillips.
Wow, 40 years.
Yeah. And he is handing the leadership over to Andy O'Brien, a 30-year veteran of the company who most recently served as Chief Financial Officer and Executive Vice President of Strategy.
Ryan Lance's tenure over the last decade and a half has been highly consequential, not just for ConocoPhillips, but really as a model for the broader independent exploration and production sector.
Oh, without a doubt.
He took over during an era when the industry was still obsessed with pure volume growth at any cost.
Drill at all costs.
Right. And he fundamentally restructured the corporate philosophy to prioritize strict returns on capital and a disciplined cost of supply.
And that's why the transition to Andy O'Brien is explicitly designed to signal absolute continuity to the market.
Which is a crucial point for investors.
Extremely crucial.
Because this is not a scenario where an activist hedge fund has accumulated a massive stake, ousted an underperforming CEO, and brought in an outside mercenary to slash budgets and radically pivot the company.
No, not at all. Andy O'Brien has been sitting right next to Ryan Lance, acting as a primary architect of this exact strategy for the past decade.
Right.
During the call, O'Brien made it abundantly clear that the foundational pillars of their strategy are locked in.
They aren't changing anything.
Exactly. The relentless focus on lowering the cost of supply, the strict capital allocation framework, and the unwavering commitment to shareholder distributions are not changing under his tenure.
Okay, good to know.
He noted that the market shouldn't confuse strategic consistency with operational complacency. I mean, they will continue to hunt for technological optimizations, but the structural playbook that investors have bought into remains entirely intact.
And that ongoing, relentless optimization of the company extends far beyond the Permian Basin, right?
Oh, absolutely.
Because a major theme of the story behind the numbers this quarter is their strategic portfolio management, specifically their global diversification efforts.
Yes, they're making some big moves internationally.
Right. While the Permian is undeniably the short-term volume growth engine, they are playing a very sophisticated, multi-decade global game of chess.
I like that analogy.
First, they announced they hit their $5 billion asset disposition target ahead of schedule, closing $1.7 billion in sales of non-core lower 48 assets just in the month of July.
Right. And asset disposition is essentially rigorous corporate spring cleaning.
Spring cleaning, right.
Yeah. A company of this size is constantly evaluating and ranking every single oil well, gas field, and pipeline they own based on its specific cost of supply, meaning exactly how cheap it is to extract the product from that specific location.
Okay.
If an asset matures or requires too much maintenance capital and becomes too expensive to operate relative to the highly efficient core of their portfolio, they package it up and sell it to smaller operators.
Got it.
So hitting that $5 billion target early demonstrates a disciplined execution of trimming the fat, leaving a leaner, more resilient, and highly profitable core portfolio.
But they're not just shrinking the overall footprint. They are aggressively expanding in highly strategic, specific verticals.
Right. Aggressively.
Starting with a massive push into liquefied natural gas, or LNG.
Yeah, LNG is huge for them.
They announced the addition of 2 million tons per annum, or MTPA, of commercial LNG offtake agreements.
Right.
One agreement is located in Indonesia, off the Bontang North Hub, and another is situated on the U.S. Gulf Coast. This recent addition brings their total global LNG offtake portfolio to 12 MTPA.
And the strategic pivot into the global LNG market is a vital evolution for the company.
How so?
Well, the fundamental economics of natural gas are highly dependent on geography.
Okay.
In the United States, particularly in regions like the Permian Basin, where natural gas is often extracted as a co-product of oil drilling, the gas is incredibly cheap.
Right, because there's so much of it.
Exactly.
Yeah.
It is abundant to the point of occasionally seeing negative local pricing because there is literally nowhere to put it.
Which is wild to think about. But the mechanics of solving that geographic pricing disparity are incredibly complex.
Very.
Natural gas in Europe or Asia is a premium, highly sought-after commodity driven by both energy demands and the geopolitical shifts that have disrupted traditional pipeline supplies over the last few years.
Absolutely.
But you cannot simply put a pipeline across the Atlantic Ocean.
No, you can't.
You have to take that cheap, abundant gas, process it through a massive refrigeration facility, and cool it down to roughly minus 260 degrees Fahrenheit.
Which takes a lot of engineering.
Right. At that extreme temperature, the gas condenses into a liquid, shrinking its volume by a factor of 600.
Wow.
You then pump that cryogenic liquid onto specialized, heavily insulated tanker ships, transported across the globe, and regasify it at the destination port.
Right. And by securing these commercial offtake agreements, ConocoPhillips is not necessarily building the massive multi-billion-dollar liquefaction facilities themselves.
So what are they doing?
Instead, they're securing guaranteed capacity. They're guaranteeing their right to take cheap U.S. or Indonesian gas, run it through the liquefaction process, and sell it into those premium-priced international markets.
Ah, I see.
They're essentially positioning themselves as a vital middleman in a highly lucrative global arbitrage game.
And just as they ruthlessly focus on a low cost of supply for extracting crude oil, incoming CEO Andy O'Brien noted they are equally focused on securing a low liquefaction fee for their LNG portfolio.
Yeah, they want the best margins.
They want to ensure they own the cheapest toll booth on the export highway.
Exactly.
And the financial leverage of this strategy is massive. O'Brien detailed that for every single $1 per million British thermal units of margin improvement they can secure, a 5 MTPA portfolio generates roughly $200 million in pure cash flow.
Which is an incredible return.
So by scaling this operation up to 12 MTPA and publicly targeting an eventual 15 MTPA, they are constructing a massive, non-drilling cash flow engine that diversifies their revenue streams entirely away from the volatility of pure crude oil pricing.
Right. And the other major strategic international move they detailed is a fascinating expansion in the Middle East.
Oh, right, the Kirkuk field.
Yes. They are committing between $300 and $500 million to formally enter the Kirkuk field in Iraq, along with acquiring some associated smaller assets in neighboring Syria.
Okay, I have to be honest here. I look at a headline announcing a $500 million investment in Iraq and Syria, and my mind immediately jumps to the immense geopolitical and security risks associated with that region.
Oh, for sure. That's everyone's first thought.
Right. What is the actual structural or financial reality of this play that makes a conservative management team comfortable deploying that kind of capital there?
Well, the initial reaction to the geography is totally understandable, but the specific financial and geological structure of this deal is what severely mitigates the surface level risk and makes it incredibly attractive.
Okay, break that down for me.
First, from a geological standpoint, these are not exploratory fields where ConocoPhillips is spending hundreds of millions of dollars drilling wildcat wells hoping to strike oil.
So it's not a gamble.
Not at all. The Kirkuk field is one of the most massive, well-known, long-life, conventional oil assets on the entire planet.
Oh, wow.
It is already producing oil. The geology is proven and heavily de-risked.
But what about the business side? Because the contract structure governing the extraction has to be the true mitigating factor.
Exactly. It's all in the contract.
Because historically, the relationship between sovereign nations in the Middle East and foreign oil companies was defined by legacy technical service contracts.
Right, which were not great for the company.
Yeah. Under a traditional technical service contract, the foreign oil company essentially acts as a glorified, hired contractor for the state-run oil monopoly.
Right.
They bring their equipment and expertise, they operate the field, and they get paid a flat, fixed fee per barrel extracted, regardless of what the global price of oil does.
Exactly.
It limits their downside risk, but it completely caps their upside potential. If oil goes to $150 a barrel, the state captures all the profit, and the contractor still just gets their flat fee.
Right. But the executive detailing this expansion emphasized that this new agreement in Kirkuk is not a legacy technical service contract.
Oh, it isn't?
No. It is a modernized joint venture agreement where ConocoPhillips receives a direct share of the incremental production they help bring online.
Oh, that's completely different.
Crucially, they are legally allowed to book those reserves on their own corporate balance sheet, and the contract allows them to recover their historical capital costs from the initial revenue streams.
And the fundamental economics of extracting a barrel of oil from a conventional Middle Eastern field like Kirkuk are vastly different from fracking in West Texas, aren't they?
Exceptionally different. They estimate the fully burdened cost of supply for this Kirkuk project at roughly $30 a barrel.
$30, that's incredibly low.
It is. Furthermore, because the field is already active and producing, the cash flow generated from the existing daily oil sales will largely fund the required redevelopment and modernization efforts.
Ah, so it pays for itself.
Exactly. After that initial $300 to $500 million entry cost, they expect this joint venture to be entirely self-funding.
Wow.
It will require little to no ongoing capital injections from the parent company, while providing a steady, reliable stream of long-term free cash flow upside.
So it's a highly calculated, low-risk, bolt-on acquisition designed specifically to balance out the naturally rapid decline rates associated with their U.S. shale assets.
Precisely.
Okay, now before we transition into management's guidance and financial projections for the future, we need to pause our financial analysis to address a specific point management made regarding the regulatory environment.
Yes, particularly concerning their ongoing exploration and development efforts in the National Petroleum Reserve in Alaska, commonly referred to as the NPRA.
Right.
During the Q&A portion of the call, the Executive Vice President of Global Operations specifically cited the previous Trump administration's actions as being continuously supportive of the development of domestic energy resources. He pointed specifically to ongoing permit reform efforts on federal leases and the establishment of a regular, predictable cadence of lease sales, like the recent NPRA sale, as highly beneficial for the industry.
Right.
Ryan Lance also contributed to this point, noting that these types of policies fundamentally strengthen long-term energy security and directly help increase industry efficiency by driving high utilization rates of existing infrastructure in remote, challenging areas.
And it is absolutely critical to state clearly to you, our listener, that as we analyze this earnings call, we are strictly evaluating this commentary through the lens of corporate cost modeling, operational efficiency, and capital deployment strategy.
Exactly.
We are impartially reporting management's stated position that a supportive regulatory environment characterized by regular lease sales and streamlined federal permitting processes allows them to more confidently deploy multi-decade capital.
We aren't taking sides here.
No, we are not endorsing, validating, or critiquing any political viewpoints or administrations. We are simply analyzing the variables management claims impact their business.
Right. And from a purely analytical standpoint, regulatory friction is a massive quantifiable variable in the financial cost modeling for any energy mega project.
It has to be.
When a management team perceives a landscape of regulatory certainty and predictability, their internal risk models fundamentally change.
Right.
It lowers the risk premium assigned to long-term projects, making them significantly more willing to greenlight massive, capital-intensive investments that take years to yield a return.
Okay, so moving forward to the final sections of the call, management provided very specific operational and financial guidance for the remainder of 2026.
Yes, they did.
Let's start with the immediate horizon, the third quarter.
Yeah.
They guided total production to be between 2.29 million and 2.32 million BOE per day.
Which is a notable and significant step up from the already record-breaking 2.248 million barrels they just delivered in the second quarter.
Right. So the immediate question that arises is how a company manages to sequentially grow production by that much in Q3, immediately after they just closed the sale of Lower 48 assets in July that were actively producing 15,000 barrels a day.
Yeah, it seems counterintuitive.
They sold off production, yet their guidance goes up.
Well, the answer lies in two distinct geographic areas.
Okay.
You have the continued, relentless organic growth in their lower 48 operations, specifically the highly efficient Permian and Eagle Ford basins, combined with a major operational ramp-up halfway across the world in the state of Qatar.
Right. Let's examine the Qatar situation because it really highlights the complexities of global operations.
It really does.
What exactly happened in Qatar during Q2 that depressed production, and why is it rebounding so strongly in Q3?
So in Qatar, ConocoPhillips holds significant, highly lucrative interests in massive liquefied natural gas facilities, specifically operating through the North Field East and North Field South mega projects.
Okay.
During the second quarter, they experienced unexpected downtime. Part of this was broadly attributed to regional geopolitical disruptions. Management alluded to regional conflict and intermittent closures of key shipping straits, which bottlenecked overall export throughput.
Right. You can't produce if you can't ship it out.
Exactly. However, overlapping with this disruption was a planned turnaround, which is the industry term for a massive scheduled maintenance shutdown at their primary Ras Laffan facility.
So they essentially took advantage of a deteriorating logistical situation.
Exactly.
Since the shipping lanes were disrupted and they couldn't export at full capacity anyway, they accelerated and executed their heavy, deep maintenance during that window.
It is a textbook silver lining operational approach.
It's brilliant, actually.
Because they successfully completed that deep, extensive maintenance during the Q2 downtime, the facility is now poised for an extended period of extremely high uptime and reliability.
So they're ready to go.
Yeah. As the local seasonal consumption needs in the region shift and the export avenues stabilize, they expect a massive, sustained production ramp across the entire third quarter from their Qatari assets.
And that international surge, combined with the steady U.S. shale growth, more than covers the production volumes lost from the July asset dispositions.
Yep, that's exactly how they make up the difference, and then some.
Awesome. Now, alongside that robust production growth, there is a very clear mathematical promise regarding shareholder cash payouts that you, as an investor, need to be acutely aware of.
Oh, this is the best part.
Right. Management explicitly reaffirmed their commitment to targeting the return of 45% of their total cash flow from operations to shareholders for the full calendar year.
And this is where the basic arithmetic gets very interesting and highly favorable for current shareholders.
And why is that?
During the call, Andy O'Brien pointed out a discrepancy in their pacing. He noted that throughout the first half of the year, combining Q1 and Q2, they only averaged about a 40% payout of their CFO.
Well, the implication of that math is straightforward. If the publicly stated unwavering goal for the entire 12-month period is a 45% payout, but they spent the first 6 months only distributing 40%, the company is mathematically obligated to significantly increase the payout ratio in the back half of the year to drag the annual average up to that 45% target.
Exactly. Management is actively and transparently telegraphing a much heavier, more aggressive distribution schedule for the remainder of 2026.
Which is great news for anyone holding the stock.
Yeah. They emphasize that they do not manage their capital distribution framework quarter to quarter based on the daily chaotic volatility of commodity prices.
Yeah, they aren't day trading their own stock.
No, they manage strictly to the annual structural target. Therefore, listeners should expect a material step up in cash returns, which will likely materialize through increased aggressive share buybacks or potentially specialized variable dividends in the upcoming third and fourth quarters.
But all of this immediate Q3 guidance, the Qatari maintenance, the H2 distribution step up, honestly, it is really just the preamble.
Yeah, it's just setting the table.
The main course, the true holy grail for understanding the long-term valuation of this company, is what management continuously refers to as the 2029 inflection point.
The 2029 inflection point.
They are firmly, confidently on track to deliver a $7 billion free cash flow inflection by the year 2029.
$7 billion.
To put that in perspective, that means they will effectively double the total free cash flow they generated last year.
Which is just a monumental leap. And the primary engine driving this massive structural leap in cash generation is not a new shale discovery in Texas.
What is it then?
It is a mammoth, multi-billion-dollar, multi-decade development in the state of Alaska known as the Willow Project.
Oh, Willow.
Yeah, Willow is arguably one of the largest, most complex, and most heavily scrutinized energy developments currently underway on the globe. Yeah, it is engineered to produce a peak of around 180,000 barrels of oil per day and sustain high production levels for decades.
Wow. But the engineering reality of building infrastructure of that scale in the extreme, hostile environment of the Alaskan North Slope is incredibly capital intensive and logistically daunting.
Oh, it's a nightmare.
Right? You aren't just pouring concrete on a flat dirt lot in Texas.
No.
You are building on top of fragile permafrost. You have to construct massive temporary ice roads that only exist for a few freezing months a year just to transport heavy modules.
Yeah, ice roads.
You have to physically install thousands of thermosiphons into the ground to continuously draw heat out of the soil, ensuring the permafrost stays frozen so your multi-ton processing facilities and pipelines don't just sink into the mud.
It's wild.
You are spending billions upon billions of dollars over several years before a single solitary drop of oil is extracted and sold.
Right. The capital burden during the construction phase of a mega project like Willow is immense. And this brings us to the most crucial valuation-altering update management provided on this call, which directly addressed analysts' skepticism regarding their ongoing spending levels.
What did they say?
They confirmed that the absolute peak of capital expenditure for the Willow project is already in the rearview mirror.
Okay, this is huge. I think about the financial mechanics of this transition, like finally paying off a massive 30-year commercial mortgage on a highly lucrative apartment building.
Oh, I like that analogy.
Right. For years, every single cent of rental income you generated was immediately eaten up by that huge, suffocating mortgage payment, plus the ongoing maintenance and taxes.
Yep.
On paper, you were cash poor, even though you owned a fantastic income-generating asset.
Exactly.
But the day finally comes where you write that last final check to the bank. Suddenly, your monthly expenses drop off a cliff. But your rental income, it stays exactly the same, or maybe even goes up because you can raise the rent.
Right, you're suddenly flush with cash.
For ConocoPhillips, when the Willow project finishes its grueling construction phase and starts pumping its first commercial oil in early 2029, their massive capital spending burden basically vanishes.
Yep.
The mortgage is paid. And they are suddenly left with a mountain of disposable, unencumbered cash flowing into the treasury every single day.
And the technical financial term management uses to describe this exact dynamic is achieving a structurally lower reinvestment rate.
Okay.
Right now, a huge disproportionate percentage of their total operational cash flow has to be relentlessly reinvested into CapEx just to fund the ongoing construction of Willow.
Which makes sense.
But post-2029, as Willow transitions from a cash-consuming construction site to a cash-generating producing asset, that overall corporate reinvestment rate plummets dramatically.
So the most vital statistic of the entire earnings call is what happens to their overall corporate break-even price when that CapEx burden is finally lifted.
Exactly. By 2029, as a direct mathematical result of this structural shift in reinvestment, ConocoPhillips' corporate free cash flow breaking price will drop precipitously from the mid-40s down to the low 30s for West Texas Intermediate, or WTI, crude oil.
Okay, we need to clearly explain why that break-even metric is the absolute floor for investors.
Yeah, let's break it down.
The break-even price is the exact price a barrel of oil has to be for the company to pay all of its operational bills, fund all its required maintenance drilling to keep production flat, and fully cover its base dividend payout without losing a single dollar or dipping into cash reserves.
Right. Currently, if global macroeconomic factors cause oil prices to crash down to $40 a barrel, ConocoPhillips would basically be treading water.
Right.
They would survive, their balance sheet would hold, but they would not be generating meaningful excess cash for aggressive buybacks.
They'd just be surviving.
Yeah. But by 2029, global oil could crash all the way down to $32 or $33 a barrel, and ConocoPhillips would still be breaking even, still funding all its operations, and still comfortably paying its dividend.
Wow.
It massively, structurally fortifies their dividend safety against almost any conceivable global economic downturn.
And conversely, if oil happens to be sitting at a moderate $70 or $80 a barrel in 2029.
Well, then the delta between their low 30s break-even cost and the $80 market price is pure, unadulterated free cash flow margin.
Which is just a massive spread.
It is. That massive spread is exactly how you arrive at that $7 billion inflection point.
Yeah.
They will have more discretionary extraordinary cash than they know what to do with, which leads straight back to aggressive, market-leading dividend hikes and relentless share buybacks.
Of course.
Furthermore, the executive team elaborated that the Willow project isn't just a one-and-done isolated asset.
No, it isn't.
No, they're executing a hub-and-spoke playbook they have utilized successfully for decades in Alaska.
Okay, what does that mean?
They used the initial massive capital investment, the Willow Central Processing Facility, as a hub. Then through ongoing, cheaper exploration programs like the one they recently concluded in the MPRA, they locate smaller satellite oil fields nearby.
I see where this is going.
Yeah, so in the 2030s, as the main Willow Reservoir naturally begins to decline from its peak plateau, they will simply drill these new satellite fields and tie them directly into the existing, already paid-for Willow infrastructure.
That's incredibly smart.
It extends the productive life and the hyper-profitability of the asset for decades, permanently preserving that incredibly low reinvestment rate.
It really is a masterclass in long-term disciplined capital allocation.
Truly.
So having dissected the engineering, the geopolitics, and the financial modeling, what is the bottom line here? We need to translate this data forward analysis into an actionable verdict for the retail investor.
Well, the verdict derived from the specific earnings call is firmly structurally bullish for retail investors. The myriad data points, the Permian efficiencies, the LNG arbitrage, the Kirkuk joint venture, and the Willow inflection all align to form a highly defensive, cash-generating fortress.
So let's break that actionable advice down for the two distinct types of listeners we have.
Sounds good.
First, for the current holders of the stock. If you already have COB sitting in your portfolio, how should you interpret this quarter?
If you currently hold the equity, management is practically begging you to remain patient, and they are actively, aggressively paying you to wait.
Because of the dividends and buybacks.
Exactly. They have transparently telegraphed the massive cash windfall arriving by 2029. In the immediate short term, with mathematical certainty that a step up in cash returns is guaranteed in the second half of this current year in order to hit that 45% CFO return target.
Right.
You are holding an asset that is systematically retiring its own outstanding shares, thereby continuously increasing your proportional ownership while simultaneously lowering its fundamental structural cost base.
And for potential buyers. If you are a retail investor looking at the broad energy sector and wondering if ConocoPhillips is the optimal place to deploy fresh capital right now,
well, the combination of their Tier 1 Permian acreage, the relentless technology-driven cost-cutting, utilizing surfactants and real-time fracking diagnostics, and a corporate break-even price structurally heading toward the low 30s makes this a uniquely highly defensive oil play.
Right.
Often, investing in the energy sector feels like gambling on unpredictable geopolitics or OPEC decisions.
It really does.
But ConocoPhillips is structured so robustly that even if global crude prices drop significantly, they remain highly reliably profitable. You aren't just buying leveraged exposure to volatile oil prices, you are buying elite execution, technological superiority, and unparalleled capital efficiency.
So it has fundamentally evolved. It is no longer just a cyclical commodity play, it is an efficiency play.
Exactly.
Which brings me to a final provocative thought I want to leave you with, something for you to mull over or explore on your own as you review your portfolio.
Oh, let's hear the thesis.
When you take a step back and look at the entire expansive landscape we just mapped out, a new CEO in Andy O'Brien, who is hyper-focused on maintaining a structurally lower reinvestment rate, an expanding LNG arbitrage strategy that provides massive non-drilling cash flow, a corporate break-even dropping to the absolute floor of the low 30s, and a free cash flow profile set to reliably double by 2029, we have to ask a much bigger existential question about market identity.
Okay.
Could ConocoPhillips soon transcend the cyclical volatile energy sector label entirely?
That's interesting because the market currently assigns them an earnings multiple based heavily on the historical assumption that they're ultimately hostage to the unavoidable boom and bust cycles of global crude oil.
Right. But if they can mathematically guarantee massive free cash flow generation, even in a severe bust, and they use that cash to systematically raise dividends year after year without fail, could we see a future where the broader market stops valuing ConocoPhillips as a risky energy stock and starts valuing it simply as an elite S&P 500 dividend growth aristocrat? Could they be viewed akin to a massive consumer staples giant that just happens to sell physical molecules instead of household soap?
Like a structural, insulated cash machine that demands a premium market valuation regardless of what West Texas Intermediate is trading for on any given Tuesday.
Precisely. It is a fundamental shift from being a cyclical survivor to a structural compounder of wealth.
That's a huge shift in perception.
And if the broader market wakes up and reprices the stock based on that new identity, assigning it a consumer staples multiple, the upside could be tremendous.
It really could.
It is something to seriously think about as you review your portfolio. Usually when you think about a 100-year-old legacy oil company, you picture a dinosaur.
Yeah.
But as the data has shown today, you might actually be looking at one of the most sophisticated cash-generating tech operations currently trading on the public market.